think about Australian growth, we like to think that we have a very unique way of thinking about growth, not just in the domestic market, but also global. But we'd argue that there is actually an abundance of growth in the domestic market, and the indexes have actually started to improve over time. Same slides as before, I'll take it for red. When we think about the index in Australia, and that really lives in this old world sector that we're really avoiding. Most of you would have exposure to your index funds, so you've probably got a bucket load of the banks, you've got the miners, you've got some tunnels, you've got some supermarkets. We think they're very low growth, low innovating, and again, they're only really going to grow with the economy around them. We wrote a white paper in 2018, it still holds true today, which was titled Beware the Index. And the reason we say beware is we want to actually have a look at where the index returns have come from over the last 10 years. And you can see here on the left chart the average weight of the buckets, the 50 to 100, 100 to 200 and 300 versus the return for the ASX. So 77% of the average weight of the ASX 300 is sat in those top 50 names, and it's only delivered around, call it 8%. If you actually zoom out and think about the return profile of the entire ASX 300, it is around 8%. So most of your returns are centred in a very small cluster of companies in the ASX 50. You'd actually be better off expanding your horizons and looking out further than that. And we've done that with the Australian Growth Companies Fund, look back over 10 years, where the average weight of our portfolio has sat and the returns that we've had. So you can see we've got about a 37% weight in that 0 to 50. We've got about a 40% weight in the 50 to the 100, which has had probably the best return profile. Don't worry about the 200 to 300. If we could put 100% of our portfolio there, that'd be awesome. We get 50% returns per annum over 10 years. That's generally companies that have graduated and gone in and then moved quickly up the ranks. Think of your Xeros, your WiseTechs, and your Afterpays. But what we're trying to illustrate here is the index, while it does play an important part in portfolio construction, there is still an abundance of growth outside of that. And then when we have a look at the sectors, you probably are aware of this. Hyperion's in the red, and the ASX is in the blue, and the MSCI World is in the yellow. Yet most of the weight for the index has really been in your financials, it's been in your banks and your resource companies, whereas Hyperion's return profile and the companies that were within our fund are more predominantly weighted into the healthcare names, into the financials, whether that's Macquarie, Hub, Net Wealth and Block, and the IT companies and the services. Now we do think that the abundance of growth gives you a unique opportunity to really invest in some of the world's best businesses that are just listed here in Australia. And again, it's a concentrated portfolio. There's 21 names in the fund. But then again, we can break it down on that EBITDA. There's over 52 different business segments again. So we think it is still a very diversified portfolio. And when we think about the companies that are within our portfolio, there's some really high quality names. If we think about healthcare, which is the largest weight, over 30%, you have some of the world leading healthcare providers that have long-term double-digit growth. It's very unique. You don't generally see this. When you look globally, the return profile of some of the biggest names are in the single digits and they're very mature. And so you're actually able to invest in some of the world leading healthcare businesses right here in Australia. We also look at companies that have no credible competition. WiseTech, ResMed, Cochlear, Pro Medicus and REA Group. We've all owned these companies for some. REA Group we bought in 2004. We've owned them for a very long period of time. Again, really high quality businesses, monopolistic in nature, with no credible competitor. And then when we think about the actual footprint where these companies are able to sell their products into, almost every single company within our product has a global revenue base. The only two that don't are Hub and Net Wealth. And to illustrate that point a little bit further, we've had a look back even to June of 2017, where the revenue for our portfolio was broadly from the domestic side, 55% of revenues of our portfolio back in 2017 came from domestic sources. Fast forward to today, only 23% of the revenue comes from a domestic source. 77% is diversified across the globe. That's why we really think the quality of a lot of the companies that we invest in has really increased over time. With that, we don't really sit on our hands in the domestic portfolio. There's 21 names. There's probably about 10 or 15 on the bench that could go in. And over the last 8 months, we've added 4 new companies to the fund. Goodman Group, really high quality. We think of them more as an asset manager, not a REIT. If you think they have leadership in distribution centres, industrial parks, and in cloud computing centres as well. Goodman's goes a little bit beyond that. They've been able to land bank and build on the centres and sites that they have. There's a lot of intelligence and historical corporate knowledge that goes into that. To give you an understanding, they have a corporate park out in Brisbane in a place called Murarrie near the bridges. Now, there's 12 or 15 different overlays that sit across that land, both environmental, local, state, and federal, one of them being a koala pathway overlay. Now, I lived in Brisbane all my life. There hasn't been a koala at Murarrie for 40 years, but Goodmans are able to work through that and be able to build on those properties quite well. Pro Medicus and Lavisa, really high quality businesses that we've been able to upgrade from our small companies fund into the large companies fund, the Australian Growth Companies Fund. And that's really on the ability of these businesses to prove that they do have global expansion capabilities. And GYG, pretty much exactly what Paddy said, really, really high quality business that we were able to take pre-IPO, first time we've ever done pre-IPO in our 25-year history. And we also supported it on day one. A little bit higher conviction. We are, I think we own about 10% of GYG to date. And that's in both the Australian Growth Companies Fund and the Small Growth Companies Fund. And again, you saw this slide with our global product, and I think it is really powerful, not just in the global product, but also in the domestic ones. EPS is compounded historically at around 10% per annum versus the ASX 300, which is run at around 4%. Now, the ASX, you also get some dividend growth, and I'm sure the Plato guys will tell you all about that. But if you want to see that capital growth, it really is that earnings per share growth that is going to drive your returns. And as these companies improve, as they expand globally, we can see that EPS forecast up to 18% per annum over the next 10 years. Again, the IRRs usually run at around 11 or 12%. It's sitting around 17% per annum for our fund. Really happy with the return profile of our domestic product. Not many managers can sit up here and say that since 2002 you've been able to outperform the benchmark by 2%, but it even gets stronger as you go down the line. So really high quality product, and there's an abundance of growth outside the index. Thank you.